My name is Eugenie Mulhern and I'm a Senior Advisor in the Corporate Transaction and Advisory Group at A&L Goodbody, and I'm delighted to welcome you to our session on environmental, social governance and sustainability, which focuses on balancing the legal and regulatory corporate risks against the opportunities. We have, I think, a very impressive panel today who I'll introduce in a moment. But first, to address the question as to why ESG is a topic for our Corporate Crime and Regulation Summit. There are very good reasons for its inclusion. There's an emerging confluence of factors which we believe significantly heightens the risk around ESG disclosures and the likelihood of a future ESG reckoning for corporates. Inevitably, this will partially occur in the court of public opinion, be they shareholders, suppliers, customers, consumers or employees. But it's also likely that it will take the form of both litigation and regulatory intervention, as well as shareholder activism. Early indicators include the near-frantic evolution of the ESG regulatory framework in the EU, at national level in a number of EU countries and in the US, with the so-called alphabet soup of standards and frameworks really only beginning to be streamlined. We are also seeing seminal cases such as that successfully taken against Shell in the Hague District Court in relation to carbon emission reductions, and the beginnings of success in a number of jurisdictions for consumer and shareholder plaintiffs using ESG disclosures against their authors. Improved monitoring of ESG disclosures by multiple market participants and an alertness to greenwashing are also emerging as important tools in holding companies to account. To help explore these developments and their implications for companies, on our panel today, we have Joanna Setzer joining remotely from the London School of Economics and the Grantham Institute on Climate Change and the Environment, which runs a global depository of climate laws, policies and litigation cases. And Professor Andreas Hoppener from University College Dublin, a member in his personal capacity on the European Commission's platform on sustainable finance and founding member of Greenwatch, which uses artificial intelligence and machine learning to assess the authenticity of climate-friendly green claims made by companies. And here in studio, we have Karen Coyle, Head of Energy, Environment and Health and Safety at AIB, and our own Anne Shields from our Asset Management and Investment Funds Knowledge Team, and Sinead Lynch, a partner in our insurance team. Together, we sound a cautionary note in relation to ESG disclosures and begin the discussion on the steps companies can take to balance the opportunity with the risk in the ESG realm. If I can start with you, Joanna. We recently saw a ruling from the Hague District Court in the case taken by climate activists against Shell, where the plaintiff successfully argued that Shell had violated its duty of care under Dutch law and human rights obligations due to inadequate action on climate change, resulting in a court ruling that Shell will need to more aggressively reduce emissions on an accelerated basis. While Shell has recently announced that they are appealing this case, I think it has jolted many companies and expanded public awareness of climate litigation and possibly also emboldened potential plaintiffs. Can you give our audience your insights on what you're observing in relation to climate-related litigation trends?
Sure. So, well, you mentioned already in the introduction that we have this database where we monitor cases that are being filed across the world in climate litigation. So we know that there are already over 1,800 cases globally. More than 1,000 have been filed recently in the 6 years since the signature of the Paris Agreement. So the majority of cases is still against governments. But we observe an increasing numbers of strategic climate change litigation against private actors. And this is where the Shell case you mentioned falls into. So until recently, climate change litigation against private actors was dominated by cases seeking to hold major carbon emitters, sometimes called carbon majors, accountable for historic contributions to climate change. So think about the proven farmer filing the lawsuit against RWE in Germany. Other cases were trying to ensure that these companies contribute to adaptation costs. And then you can think about all the cities and states in the US bringing cases against the majors. These cases were backward-looking. And what we see now is also cases that are trying to bring change into how these companies operate in the present and especially into the future. So if I can emphasize three trends very briefly. One, cases that are forward-looking, like the Shell case in the Netherlands and Notre Affaire à tous against Total in France, and also new cases that have been just brought last week against car manufacturers. If you heard about these cases, it's a German environmental organization, the H, that has filed action against Mercedes-Benz and BMW, arguing that these companies are refusing to tighten their carbon emissions targets and to give up fossil fuel emitting cars by 2030. So these cases are focused on the need for these companies to incorporate the Paris Agreement and be compliant to Paris in their emissions. And they're primarily happening in the EU. But then two other types of cases, very briefly. One, the finance-focused cases that aim at increasing the costs of capital for polluting activities. So these are often brought by shareholders or sometimes even by pension fund beneficiaries. These have originally focused on disclosure, but now we're seeing also a trend coming especially from Australian cases that are focused on due diligence. And a good example is the McVie versus the Retail Employees Superannuation Trust Fund in Australia, which was and ended up being settled before the trial began. And finally, maybe also interesting to highlight the greenwashing and the net zero litigation cases. So many of the US cases seeking compensation, these were already emphasizing the disinformation campaigns by fossil fuel industries. But they also emphasized that aspect of the disinformation campaigns. What we see is also cases that are exclusively looking into this, announcements, advertisements, and campaigns. And to an extent that some are starting to refer to these as climate washing litigation. So just to finish, I think also it's important to see how many of the net zero plans that are being put forward might also be subject to litigation, particularly if they are not credible. And I can maybe describe some examples when we continue the discussion.
Thank you. And Andreas, with your experience in Greenwatch, where you focus on detection of greenwashing, do you think potential greenwashing litigation should be or will be a risk management issue for businesses? And more generally, what do you see as the key drivers towards ESG integration, which many businesses in our audience will be facing?
I believe greenwashing litigation will indeed potentially be a problem for businesses. I believe that businesses, many of them, a lot of them, are seriously struggling to take green initiatives from a scientific perspective. Far too often green initiatives are really executed with a chief marketing officer, a chief PR officer as kind of a practical champion. So in that sense, businesses really, especially when it comes to Paris Agreement, need to look at themselves and saying there is a transition ahead. If we take this serious, are we accurately accounting for Scope 1 emissions, accurately accounting for Scope 2 emissions, and at least estimate Scope 3 emissions to the best of our abilities, and are we then taking responsibility for it? We have seen that Total, for instance, outright rejected that. Shell's phrasing of the net zero target is also more conditional. If consumers want it, we'll do it, but if consumers don't want it, we may or may not do it. So in that sense, I think we have a scenario where companies need to realize, and particularly non-financial companies need to realize that the world is changing and they're expected to actually live up to net zero targets if they haven't set them, and then execute accordingly rather than just hope that they can delay it and at some point the pressure will reduce, which I think too many companies are still believing that this is a PR issue rather than a scientific issue.
Joanna, when you look forward, what do you see as the main evolving trends in ESG litigation? Would you, for example, see wider ESG litigation trending in the same way as climate litigation is?
Yes, I think this is something to keep an eye for. So one of the issues for businesses to be looking at is this net zero plans. It's likely that all businesses will need to have net zero plans, and this is clear from the decision on the Shell case. But the net zero plans will also need to be very robust and credible and clearly aligned with Paris. So offsets are also likely to be a major pinch point, given that not every business can simply offset all emissions because of the limited global capacity for removals. If I can just bring a case to illustrate this, last month, an Australian organization, it's a self-styled shareholder organization, launched a legal action against Santos in the Federal Court of Australia, challenging exactly Santos's claims that natural gas provides clean energy and that it has a credible and clear plan to achieve net zero emissions by 2040. So this is probably the first court case in the world to have challenged the veracity of a company's net zero emissions targets for being misleading. And it's also a test case in relation to the viability of carbon capture and storage and the environmental impacts of blue hydrogen. So if you bring all of this together, I think it does indicate how we might see more of this ESG litigation together with climate litigation in the present and near future.
Thank you.
Can I just jump in? Not a single oil and gas company fully takes account of their Scope 3 emissions in the net zero plans. So we're in a scenario where you have oil and gas companies that have Transition Pathway Initiative of London School of Economics and Imperial get a 4. When you look at them in detail, a lot of them are not ready to make accurate net zero plans or to execute them. And the only oil and gas company that has written off actual financial assets prior to COVID due to climate change was Repsol. So we're in a scenario where the vast majority of oil and gas companies are very clearly playing a PR exercise, not a technical scientific exercise. Total has openly admitted that in recent weeks.
Andreas, I suppose in a similar vein in terms of assessing information that companies publish, we saw that in March 2020, the World Economic Forum published a white paper on ESG, and one of the areas it focused on as likely to be impactful for ESG in the future was the hyper-transparency of corporate practices in the fourth industrial revolution, that is the era of artificial intelligence. And I know this is an area you and Greenwatch have a particular interest in. Could you tell us about the Greenwatch project and its relevance for companies in our audience today?
Yeah, so we are simply looking at the statements that companies are making in terms of their sustainability leadership, and we're comparing that to the actual greenhouse gas reductions that companies have been able to produce. We're requiring companies to reduce 7% greenhouse gas emissions year on year, as required by the EU Paris Line benchmark and the EU Climate Transition benchmarks. If companies make these reductions, we're very happy for them to credibly call themselves a leader. If companies do not make the reductions, but they have rather bold statements in the public sphere, then we estimate that they're either a probable or potential greenwasher, depending how bold the statement is. Directly to say, companies that do not talk themselves green, they can't be a greenwasher. Companies that only make very, very careful statements, such as we have reduced our greenhouse gas emissions 1% last year, and we're trying to do a little bit more this year. Make statements that are very incremental, but obvious to the consumer that they're incremental. And these type of statements would also be fine. But you may guess that most companies make a lot bolder statements and do not live up to them. Not all, but most.
Okay. And Karen, as an EU credit institution, given the ongoing developments we've heard about in relation to litigation and enforcement and the increasing regulatory obligations, how is AIB thinking about its ESG strategy?
Yes, Eugenie. So I suppose banks have really been at the forefront of regulations in this area over the past couple of years. So in 2018, the EU published its Sustainable Finance Plan. And then last year we had the ECB coming out with its guidelines on climate-related and environmental risks. So for AIB, we've really looked at, suppose, 5 major aspects of the regulations to inform our ESG strategy. And they're broken down between disclosures and then the EU taxonomy and the loan origination and monitoring guidelines. So on the disclosure side, we've been focused on the TCFD, the Non-Financial Reporting Directive, and then the UN EPFI, or the Principles for Responsible Banking and Investment. And then just during the summer, we announced we will be the first Irish corporate to report under the World Economics Forum new stakeholder capitalism metrics. So that is in an effort to clear up some of that alphabet soup and, you know, have that increased transparency across those. Then moving back over to the, I suppose, the credit and the lending side. So the EU taxonomy, which has been a major focus for us this year, which So that is around the technical screening, which determines whether our lending qualifies as being transition or sustainable. And then around the loan origination guidelines. So that has been a fairly intensive piece of work for us. So, and I'll just call out maybe one or two articles within that which have informed our strategy. So Article 59, which says that institutions, so financial institutions, should position their environmental and sustainable lending policies within the context of their overall business strategy, and they should have targets in place to support the integrity of their lending activity. So for us, that's around our net zero targets. So we've announced by 2030, 70% of our new lending will be green, and by 2040, 100% of that, excluding agriculture, will be green. And we've clearly called out that sustainability is a key pillar of our business strategy. Another article within that of interest is around Article 27, which is on the credit risk culture within the organisation. So banks must ensure that when we're granting credit, that its impact on ESG factors is taken into account, and that there is, a strong tone from the top. So that is quite a big change for financial institutions. So for us, that is taking the format we've recently published on our website, our Green and Transition Lending Framework. We have called out our exclusions sector. So these are sectors of industry which we won't lend to, and that's based on the various ESG factors, for example, the adult entertainment industry, or for fracking. If you're now a large corporate customer and you're in one of the sectors which is more at risk from climate change, we will engage with you in terms of an ESG questionnaire to try and understand a bit more of how those factors will affect your industry. And the big, I suppose, issue around all this is around data capture, so in terms of collateral. So we will need your ratings, etc. So we'll be asking for a lot more information from organisations.
Okay. And can you break that down a bit for us in terms of across your business lines, the retail, corporate banking, lending, and where you see the opportunities, not just the risks around ESG?
Yeah, so I suppose the key thing about all of this is where there's risks, there's also lots of opportunities. And one, I suppose, area which is quite, AIB has kind of been at the forefront is around, particularly our treasury, where we have launched 2 green bonds. So we've 1.75 billion of funds between last year and this year within that. And we've just recently published our social impact bond framework. And so what this is an aim to give transparency around funds targeted towards providing lending which has a positive societal impact, or in the terms of the green bond, is channeled towards providing funds for green lending. So in terms of the social impact bond, which we hope to launch in the near future, we will be allocating the net proceeds of that bond towards a loan portfolio which will cover access to education or healthcare, and targeting towards non-profits or SMEs in disadvantaged areas. And one of the key differences, so alluding to, the theme of this is around transparency. So in terms of these type of bonds, is that we will be publishing and reporting on the actual impact of that funds. And then looking towards the more consumer side, so on the corporate side, we have launched for the larger corporate sustainability linked loans. So that's where the interest rate is linked to achieving ESG targets. And then on the retail side, and for consumers and SMEs, we just recently launched our Green Living site, which is to guide people kind of on that journey. Because the one thing we want to do is work with customers and consumers around managing that transition to a more climate sustainable society. And then within that is to provide the products that will meet the customer's needs. So be it a mortgage, a green mortgage, or a green personal loan, or depending on what the particular requirements are.
Okay. And Anne, I know you've done a lot of work within the asset management and investment funds team for our clients in relation to the Sustainable Finance Disclosure Regulation and the Taxonomy Regulation disclosure requirements, and you have a particular interest in sustainability and ESG for ALG's clients more broadly. From your perspective and what you've seen to date, are there lessons for the broader regulated financial services industry and indeed other industries?
So yes, it certainly was busy for our clients in the run-up to the 10th of March this year, which many of you will know was the deadline for compliance with the first phase of disclosures under the Sustainable Finance Disclosures Regulation. So I'll just mention 5 points in relation to that question. So firstly, tailored SFDR disclosures are important from a regulatory supervisory perspective, I would say, and potentially from a regulatory enforcement perspective. So just to remind ourselves, SFDR applies by and large to regulated financial services entities and their products. So what you wouldn't want to see is an element of homogeneity creeping into those disclosures. You could, within an industry or a sector, I mean, I think you could see why that might happen, because these disclosures are new for everyone, they're technical, the phased implementation pathway isn't straightforward, they're flanked by the taxonomy environmental disclosures, and then we've had delays to contend with in the regulatory technical standards that underpin the content and methodology of what needs to go in there. So some challenges, but the end result should not be market standard disclosures. Secondly, it's important that sustainability disclosures or ESG statements are supported by facts and data. And I think that sort of echoes what Joanna and Andreas and Karen have already talked about. So I like to think of SFDR disclosures as talking the walk. So if you have the walk in place, so your internal sustainability policies, your purpose, your values, and you're executing them, then I think the talk, which is the disclosure, should follow quite naturally and match. So third point, ambition and aspiration for sustainability are really important. What is equally as important for organisations is that the organisation takes authentic, credible and measurable steps to back that up. And I think that translates across many sectors. So for example, marketing claims, or environmental claims in marketing documents are important. You need to tread carefully, and I know that A&L Goodbody's advertising and marketing law team have looked closely at the Irish position on that recently. So on the positive side, increasingly likely that robust steps in this regard will bolster not only reputation but also financial value, and I think there's more and more examples of the market attaching value to ESG claims. Some of you might have seen reports of the share price slump of a large global asset manager in the last month or two, and that was in response to media commentary by a former employee around ESG credentials. Following on from that, as a fourth point, so we've seen clients that deal successfully with disclosures recognise that there should be strong internal awareness and ongoing education around ESG developments and accountability, so good housekeeping. I think, for example, internal protocols around financial statements, they should be as rigorous for ESG and vice versa. So finally, and this is more on the regulatory reporting side rather than the regulatory disclosure side, an important development to watch is the upgrading of the non-financial reporting directive to the corporate sustainability reporting directive. So I think even the terminology there speaks volumes. You're going from non-financial to corporate sustainability. So that's going to affect reporting by large corporates. And also remember that the taxonomy regulation obliges entities subject to the non-financial reporting directive to report against taxonomy alignment. So there's lots of other points we could talk about, Eugenie, in response to that question, but they're the ones I thought to mention today.
And Sinead, you're a partner in our ALG insurance team where there's been significant activity in relation to ESG. What are the key areas of focus that you're seeing?
We set up the firm's climate action group 2 years ago because we expected a wave of developments. But to say there's been one is really an understatement. It's been coming really thick and fast. We've been brainstorming and we've been helping clients with preparing and training. And what we're finding is that although regulated sectors will have their own tailored ESG focal points, there are many common themes across all businesses when it comes to ESG. Disclosures, of course, to the public, to regulators, and that's been very well covered today. But also areas like investments. Are we using our buying power in a way that supports ESG efforts? Governance and decision making on ESG, also a big focal point. On top of that, risk management, identifying and monitoring and reacting to ESG risks in a holistic way. Another core focus will be using green to support capital. And clearly governments, legislators and regulators have a key role in driving disincentives, as the case may be, or incentives in that regard. The whole area of outsourcing and support industries is also very important. Making sure we're holding providers to account, providers to our business to account on ESG. And finally, reputation and brand. ESG will be a market share driver, and that's the case whether you're a bank or an insurer or another kind of business. But overall, though, Eugenie, I would say that the most important theme is actually integration. If we're doing it well, ESG has to be fully integrated into the business, top to toe. It's important all the way from strategy and culture right down to who we're buying our coffee from. And our work with clients would tell us that while there are varying levels of preparedness for ESG process and planning, integration might actually be the biggest challenge of all for most.
Okay. And we've heard today a lot about ESG litigation. Do you see regulatory intervention as a substantial risk as well?
I do, I have to say. Litigation in this space, of course, is something that all businesses will want to avoid. But for regulated firms, exposure to regulatory enforcement is also very real. Until recently, ESG was a pretty soft landscape, but hard ESG rules creeping into regulated regimes changes the game on that score. Let's remember regulators themselves will be in the spotlight and under pressure on ESG matters. And the whole area is underpinned, of course, by a global political and customer focus. So I think we can expect regulator push and activity to be commensurate with that. So here in Ireland, a few strong messages coming through from the CBI around ESG. The first is really understand where ESG hits your business, including the hidden impacts. For example, an insurer covering weather risks will have planned and reserved for that. But what if I'm an insurer underwriting D&O cover, where directors and officers in an insured entity might ultimately be on the hook for ESG failings? The second message from the CBI would really be substance over form. So try not to let ESG become a compliance piece or a checklist. In the CBI's own words at a talk they gave recently, that's the last thing they want. And connected with that, a big focus from the CBI on ownership of ESG within the business, including at board level. So it's key to ensure the right people are engaged in the business on ESG matters. And the third message from the CBI is you'll be hearing from us. So we know that there is a Dear CEO letter expected to be issued by the CBI to all regulated firms on ESG in the coming months. And no surprise, but ESG confirmed by the CBI to be a strategic focus and priority for the CBI. So watch this space.
Thank you. So I think we can be very confident of more regulatory attention in this space. And before I turn back to you, Sinead, to wrap up our session today, can I just revert to each of our panel members for their final thoughts? And I would like in particular for you to think of one message today which you'd like to give our audience. Maybe turning to you, Joanna.
Sure. So 3 thoughts. One, the importance of monitor and assess this fast evolving area and the related regulatory requirements. Second, to raise awareness among board of directors, officers, senior executives about the need to act, so to reduce emissions, to prepare for impacts of climate change, but also on the risks of inaction. And lastly, to assess the potential climate risks. And these include the physical risks, but also transition and litigation risks.
Thank you. Anne?
So for me, I would say to embrace the regulatory push for sustainability drivers, and really there I'm thinking about policy and regulation coming from the EU Action Plan on Sustainable Finance. So I think try and see it as a process with lots of support actors around it, and remember that it will evolve.
Thank you. And Karen?
Yeah, I mean, I would echo Anne and Joanna's points about understanding, what regulation is coming down the track for your particular industry or sector, and to understand what is the transition pathway for your business to becoming, in a climate secure world. And as it's never too early to start.
Yeah, thank you. And Andreas, finally?
For companies, this is a scientific engineering exercise. You have to get to net zero. You have to take ESG serious. You have to take it out of PR into operations. For investors, in particular bankers, every brown bond you're buying, every brown loan you're giving is visible, can be estimated. The public will be informed. So please give green loans, buy green bonds, SDG-linked bonds, and so forth. And for the regulators, it is very much as the previous speaker said, substance over style. It's in your own interest, in particular for the politicians driving the regulators, A lot of votes were won at the last European election with the topic green, and there will be more and more, in my view, won at forthcoming elections given the generational shift. And so substance over style, please, when it comes to the regulation.
Thank you very much, Andreas. Sinead, I'll just hand over to you to wrap up.
Thanks, Eugenie. Well, it certainly sounds like businesses will need focus and help in order to manage the pace and volume of ESG developments. So making sure you have the right support internally and externally in that effort is going to be really important. Over 40 years ago, Marshall McLuhan, a Canadian philosopher, said, "There are no passengers on spaceship Earth, we are all crew." He was talking about saving the planet, but when it comes to saving the business from exposure, it's the same principle, I suppose. All hands on deck. And that's the lens through which ESG enforcers are likely to be looking. So just before we draw the session to a close, I want to thank Joanna for giving us that valuable intelligence around trends and likely direction of travel on climate litigation. Andreas for speaking with us about drivers for change and the importance of the science and the data to support that. Karen for those very interesting insights into how AIB is approaching ESG and the opportunities that it sees. And of course, Eugenie and Anne. It truly is an absorbing topic and gathering pace and significance rapidly. We hope you've enjoyed the session and thank you for joining.